If you use Venmo, Cash App, or PayPal to receive money in any situation, whether regularly or just once in a while, this is something you need to understand before the next tax season arrives. In 2025, the IRS continues expanding how digital payment platforms report transactions. And this expansion is affecting millions of people who never thought tax reporting rules applied to them. Many of these individuals are not business owners. They are everyday people who use payment apps because cash is disappearing and digital payments are faster, easier, and more common. The issue is not wrongdoing. The issue is misunderstanding how modern income is tracked and how the IRS now connects that data to individual tax returns. Over the last decade, income has changed dramatically. In the past, most people earned money from one employer, received one paycheck, and had taxes withheld automatically. Today, income often comes from multiple sources at once. Someone might work a full-time job while selling items online, freelancing on weekends, receiving digital payments for services, or collecting money through peer-to-peer apps. These income streams feel informal, but the IRS system does not classify income based on how casual it feels. It classifies income based on whether money was received and whether it can be verified. As payment apps grew, billions of dollars began moving outside traditional payroll systems. This created a visibility gap. The IRS could not easily confirm whether income reported on tax returns matched actual activity happening through digital platforms. The expansion of Form 1099-K is the government's attempt to close that gap. It is not a new tax. It is not a punishment. It is a reporting update designed to match data more accurately. What a 1099-K really is and what it is not. One of the biggest misunderstandings surrounding the 1099-K is emotional. People see the form and immediately feel alarmed, but it is critical to understand what this document actually represents. A 1099-K is not a bill. It does not mean you owe taxes. It does not mean you are under investigation. It is an informational form that tells the IRS how much money was processed through a third-party payment network under your name during the year. Payment platforms such as Venmo, Cash App, and PayPal are classified as third-party settlement organizations. When they process payments, federal law may require them to report certain transaction totals to the IRS. The form they use for this reporting is the 1099-K. The key detail is that the form shows gross transaction volume. It does not calculate profit. It does not subtract expenses. It does not account for refunds, fees, reimbursements, or transfers. It simply shows how much money moved through the platform. This is why many people believe the number is wrong. In most cases, it is not wrong. It is incomplete. The IRS receives the total. You provide the explanation. That explanation happens on your tax return, where income, expenses, and non-income activity are properly categorized. The 1099-K alone does not determine how much tax you owe. It only gives the IRS a number to match against your filing. Why the IRS expanded 1099-K reporting? For decades, tax reporting relied heavily on employers. Payroll systems withheld taxes automatically and reported income directly to the IRS. This made compliance relatively simple for most workers. However, as technology evolved, income sources diversified. Freelancing, gig work, digital sales, online services, and app-based payments became normal. Yet reporting systems did not evolve at the same pace. The IRS recognized that a growing portion of income was flowing through digital channels with little third-party verification. This did not necessarily mean people were trying to avoid taxes. In many cases, individuals did not even realize their activity might be considered reportable. The expansion of 1099-K reporting is the IRS's response to this structural change. Their goal is consistency and accuracy, not punishment. By requiring payment platforms to report transaction totals, the IRS gains visibility into modern income patterns. This allows them to match reported income more effectively and reduce discrepancies between what is earned and what is reported. In 2025, this system continues expanding as part of a long-term transition toward digital income tracking. The 2025 IRS 1099-K update explained in practical terms. The 2025 update does not change what is taxable. income rules already existed long before payment apps. What has changed is who receives reporting forms and how many people are now visible within the IRS matching system. The IRS has chosen a gradual enforcement approach instead of implementing all changes at once. This has created confusion, as different thresholds and timelines have been discussed publicly. In practical terms, more people will receive 1099K forms in 2025 than ever before. Many of these individuals are not full-time business owners. They may sell items occasionally, perform small freelance tasks, or receive digital payments out of convenience. Receiving the form does not automatically mean taxes are owed. It simply means the IRS has received data associated with your account and expects your tax return to explain it. This is where most stress occurs. People are not prepared to reconcile totals because they never track transactions intentionally. What felt casual suddenly becomes formal. The IRS system does not interpret intent or frequency. It only matches numbers. What Venmo, Cash App, and PayPal actually report. A major source of misunderstanding is believing that payment apps decide whether something is taxable. They do not. These platforms only report transaction categories based on how payments are processed. Payments marked as goods and services are typically reportable. Business accounts are commonly reportable. Commercial activity processed through these systems may appear on a 1099K. Personal payments between friends are generally not income. However, classification matters. Writing notes such as gift or rent does not override how the payment was processed. The memo field exists for user reference only. If the transaction was categorized as goods or services, it may still be included in reported totals. Another common issue involves reimbursements, refunds, and transfers. These are not income, but they may still pass through reportable systems. When that happens, they can appear in gross totals, even though they are not taxable. The IRS cannot distinguish context from the form alone. That explanation must come from your tax return. This is why separating personal and income transactions is so important. When everything is mixed together, reconciliation becomes difficult. When transactions are organized, explanations become much simpler. Common mistakes that lead to IRS letters. Most IRS letters related to 1099K forms are not audits. They are automated notices triggered by mismatches. The IRS system compares information received from third parties with what appears on a tax return. When the numbers do not align, the system generates a notice requesting clarification. The most common mistake is ignoring the form entirely. Since the IRS already has a copy, omission is easily detected. Another mistake is assuming that nonprofit money does not need to be reported at all. Gross amounts must still be addressed, even if the net taxable amount is zero. Mixing personal and income transactions further complicates reporting and increases the likelihood of discrepancies. Underwithholding is another major issue. Many people earn additional income through payment apps, but never adjust their paycheck withholding. When tax season arrives, they are surprised by a balance owed. This is not due to wrongdoing. It is due to misalignment between income sources and withholding structure. How PaycheckPerfect supports proactive planning. PaycheckPerfect does not file taxes or replace professional tax advice. Its purpose is awareness. It helps users understand whether their paycheck withholding supports additional income sources. Most payroll systems are designed for one job and one income stream. Modern income often involves several streams at once. By understanding withholding early, users can avoid last-minute stress. Instead of reacting to surprises, they gain clarity ahead of time. This proactive approach reduces confusion and helps people stay aligned with how the tax system actually works. What you should do before tax season. The smartest approach is preparation. Reviewing payment app settings, separating personal and income activity, tracking monthly totals, and understanding paycheck withholding can prevent most problems. Waiting until April creates pressure. Understanding your situation early creates control. The 2025 IRS 1099K update reflects how money moves today. Digital income is visible. Reporting is expanding. This does not mean people should panic. It means people should understand the system they are operating within. Knowledge removes fear. If you use Venmo, Cash App, or PayPal in any capacity, Take time to understand how reported income connects to your taxes and paycheck. Visit paycheckperfect.com or download the Paycheck Perfect app on the Apple App Store to better understand your withholding before tax season arrives. Staying informed now is far easier than fixing confusion later.